Broadcom designs, develops, and supplies various semiconductor devices with a focus on complex digital and mixed signal complementary metal oxide semiconductor-based devices and analog 3 to 5 based products worldwide. And analog 3 to 5 is based on the elements in the periodic table, so they are in column 3 and 5, so that's why it's named like that. Over the past year, they have actually up around 7.5% at the time of recording, so that is pretty good. But as you can see, they had a pretty huge peak around New Year and then again around April. But since we are actually down in a pretty slump right now, so it could be potentially a good place to enter, I would say. The market cap right now at the time of recording is just over 200 billion and the share price is $505.70. It has a forward non-GAAP PE ratio of 13.47 and compared to the 5-year PE ratio, it's actually 7.6 below because it usually sits around 14.58. So that's pretty good and a definite check. It does have revenue growth over the last 5 years and the profit margin is well above that 10% I would like it to be at. It's actually at 25%, so that is a definite check. Net income is also growing, which is really nice to see. And they are doing share buybacks. Again, 2 good checks right there. The dividend yield is sitting at 3.29%, which is also a definite check. And the payout ratio is very healthy at 49.33%. So they are investing a lot of money into dividends and they are also investing a lot of money into themselves. The dividend growth rate over the last 5 years is 34.82, so that is massive. And the dividend growth history is for the past 11 consecutive years. So the dividend per share is thus increasing. It has a really nice free cash flow growth and the long-term liabilities are coverable by 5 years of free cash flow. They could do it at 4.6 years. The price to free cash flow though is not below that 15 to 20 mark. It's actually sitting just above at 20.9, so I wouldn't be too worried about that. It is a growing company. They do have massive amount of free cash flow, so it is looking really good, I would say. And it appears to be trading at a pretty fair value compared to the free cash flow right now. So before we get into the verdict, if you do like these snapshots, please subscribe to the channel for more content in the future. It really helps me out a lot, and consider liking the video when you're done watching it. And let's get right into the verdict, which is 13 checks out of 14, which is, I think so far, one of the best cards I've made. It is at a fair value right now, I would say, but it's a company that is working with high leverage and it is what it is. But in an environment where the rates are increasing, that could become a problem. But I see no problems with their free cash flow not covering the debt, so I wouldn't worry too much about that. And they are looking into acquiring VMware, and that deal looks really accretive to the company, so there's also paved some growth in the future. So even though it's sitting around the 500, I'd say it's a pretty good entry point if you are looking to get into this type of company. So thank you so much for joining, guys. Leave a like, consider subscribing as I said before, and if you have something you would like me to look at, leave it down in the comments. I'll see you in the next video. Bye.